Ever wonder how the super rich keep their fortunes growing, generation after generation? It's not about secret loopholes. It's about smart, strategic moves anyone can learn. In this video, I'll reveal the 7 most effective strategies the top 1% use to protect their assets, minimize taxes, and ensure their wealth lasts. We'll cover everything from holding companies and trusts to diversification and passive income. My goal: give you a clear, actionable look at these powerful tools. By the end, you'll understand the principles the wealthy use, and how you can start applying them. Get ready to take notes as we dive into the real playbook of the ultra-wealthy. Stick around for the last point. It's something you can implement right away. Let's start with offshore accounts, a term that sounds mysterious, but is actually a legal, strategic tool for the wealthy. An offshore account is simply a bank account in another country. For Americans, that could mean Switzerland, Singapore, or even Canada. The main reasons? Asset diversification and privacy, not secrecy from the IRS, but protection from lawsuits and prying eyes. International agreements require you to report these accounts, so it's not about hiding from authorities. Instead, it's about putting your assets in stable, secure environments and hedging against economic or political risks at home. Offshore accounts also open doors to global investment opportunities you can't access domestically. Think of it as putting your valuables in a high-security vault abroad. Fully legal, but much harder for unauthorized people to access. Countries like Switzerland offer stability and sophisticated financial services, making them attractive for those with international interests. For the wealthy, it's common sense risk management and a way to diversify both geographically and politically. It's not about evasion, it's about building a financial fortress with walls in different parts of the world. Offshore accounts are a foundational piece of wealth protection for many of the world's richest people. So next time you hear offshore account, think strategy, not scandal. Used correctly, they're a smart way to protect and grow your assets. The key is transparency and compliance with all reporting laws. For those with global ambitions, offshore accounts are a powerful tool. They're not just for the ultra-rich. Anyone can use them to diversify and protect their wealth. It's about being proactive, not secretive. Now let's talk about holding companies. A simple but powerful way the wealthy organize and protect their assets. A holding company doesn't run a business. It owns other companies or assets like real estate or stocks. Instead of owning everything in your own name, you create a holding company, often an LLC or C Corp, and transfer your assets into it. The main benefit? Liability protection. If someone sues one of your businesses, your personal assets are shielded. The wealthy often go further, creating separate LLCs for each asset, all owned by the holding company. This compartmentalizes risk. It also streamlines management. Income and expenses flow through the holding company, simplifying accounting and tax planning. Selling assets can be easier and more tax efficient too. Holding companies add a layer of privacy, making it harder for the public to trace ownership back to you. It's not about hiding from the government, but about reducing your profile as a target. For estate planning, holding companies make transferring wealth to heirs much simpler. Just pass on shares of the company. This structure preserves your portfolio's integrity and ensures a smooth transition to the next generation. The wealthy use holding companies to build, protect, and efficiently transfer their financial empires. It's a core component of lasting wealth. Even if you're just starting out, understanding this structure can help you plan for the future. Think of it as building a fortress around your assets. That's how the rich stay protected. And you can too. The wealthy see debt differently. They use it as a tool, not a trap. The key is leverage, using borrowed money to buy income-producing assets, especially real estate. For example, instead of buying a $100,000 property outright, a savvy investor uses that as a down payment on a $500,000 property, borrowing the rest. If the property appreciates by 5%, that's a $25,000 gain. On your $100,000 investment, that's a 25% return. Tenants pay rent, covering the mortgage and expenses, while your equity grows from both appreciation and loan paydown. Real estate also offers major tax advantages. Depreciation, mortgage interest, and other deductions can dramatically reduce your taxable income. This is why real estate is a cornerstone of wealthy portfolios. But leverage is a double-edged sword. If values drop, losses are amplified. The wealthy do their homework. They buy in good locations, analyze cash flow, and keep reserves for surprises. They use debt strategically, not recklessly. The goal is to acquire assets that generate income, appreciate, and offer tax benefits. all with other people's money. This approach accelerates wealth building far beyond what's possible with cash alone. The lesson: don't fear debt, fear bad debt. Use leverage wisely, and you can build wealth like the pros. Real estate, when managed well, is a powerful engine for financial growth. It's about making your money, and the banks, work for you. The wealthy master leverage to multiply their returns. That's how fortunes are built, one property at a time, and you can start with your very first deal. To protect wealth for generations, the rich rely on trusts, a cornerstone of estate planning. A trust is a legal arrangement where a trustee manages assets for beneficiaries, following your specific instructions. Unlike a will, a trust avoids probate, keeps your affairs private, and lets you control how and when your heirs receive assets. Revocable living trusts let you stay in control while alive and make transitions smooth after you're gone. Irrevocable trusts offer powerful asset protection and can reduce estate taxes. Once assets are in, they're out of your personal estate. This shields them from lawsuits and can save your heirs millions in taxes. Wealthy families use complex trusts, like dynasty or charitable trusts, to protect assets, minimize taxes, and support causes they care about. Trusts aren't just for billionaires. They're a tool for anyone who wants control and protection. They let you create a rule book for your money, ensuring your legacy lasts. The key is planning ahead and using the right trust for your goals. With a trust, you're not just leaving money, you're leaving a plan. It's the ultimate tool for control, privacy, and generational wealth. That's how the rich turn money into a lasting legacy. The wealthy know, it's not what you earn, it's what you keep. Their secret: legal tax optimization. They focus on generating income from investments like capital gains and dividends, which are taxed at lower rates than salaries. That's why billionaires often pay a lower effective tax rate than employees. It's about income type, not loopholes. They maximize deductions, credits, and tax-advantaged accounts like retirement plans and HSAs. Strategies like tax loss harvesting and 1031 exchanges let them defer or reduce taxes on investments, especially real estate. Charitable giving is another tool. Donating appreciated assets means a big deduction and no capital gains tax. The wealthy plan taxes year-round, not just in April. Every financial move is made with tax impact in mind. They use the rules as written, legally and ethically, to keep more and grow faster. The lesson: be proactive, not reactive, about taxes. Learn the basics, use available tools, and think like an investor. Tax optimization isn't just for the rich, it's for anyone who wants to build wealth. Play the tax game smart, and you'll keep more of what you earn. Diversification is the only free lunch in investing, and the wealthy never put all their eggs in one basket. They spread investments across stocks, bonds, real estate, and commodities, reducing risk without sacrificing returns. If one asset tanks, others can cushion the blow. The rich diversify not just within stocks, but across asset classes and even countries. This protects them from market crashes and black swan events. A diversified portfolio is a shock absorber for your net worth. It also enforces discipline: no chasing fads or betting the farm on one trend. The goal isn't to hit home runs, but to avoid striking out. Consistent singles and doubles build lasting wealth. The wealthy know, the real secret is not losing money. Diversification is about capital preservation first, growth second. Spread your bets and you'll weather any storm. That's how fortunes survive and thrive over time. The ultimate goal of the wealthy? Passive income. Money that flows in whether you work or not. When your passive income covers your expenses, you're financially free. The rich build this through dividends, rental income, royalties, and interest from lending. Stocks pay dividends, real estate pays rent, intellectual property pays royalties, and lending earns interest. These streams require effort and capital up front, but become self-sustaining engines over time. Passive income protects you from job loss, illness, or economic downturns. It's the foundation of true financial independence. The wealthy spend their active years building these streams so they can enjoy freedom later. Anyone can start. Buy a dividend stock, a rental property, or create something valuable. The key is to make your money work for you, not the other way around. Build systems, reinvest, and let your assets generate income. Passive income is the end game of wealth creation. That's how the rich buy their time and their freedom. There you have it. The 7 core strategies the wealthy use to protect and grow their fortunes. It's not about secrets, but about understanding and applying smart principles. Asset separation, good debt, tax minimization, and diversification. Start small. Open a Roth IRA, buy an index fund, or save for your first rental property. The strategies scale, but the mindset stays the same. Focus on what you can control, keep learning, and play the long game. If you found this valuable, like and subscribe for more smart financial content. Thanks for watching. See you in the next video.